The problem with option trading, the reason you're losing so much money doing it is because you have to nail a move to the exact magnitude in a certain amount of time, which is the hardest thing to do. But did you know there's option trading strategies that can allow you to profit from small movements, even no movements in the stock? I'm going to teach you those in this video. Stay tuned. My name is Market Moves. I run a professional option trading group. If you want 7 days for free, click the link below. But what I'm going to do is I'm going to show you on Robinhood on my cell phone how to implement every one of these strategies, what they mean and how they produce profits, because we all know sometimes buying puts and buying calls can lead to complete downfall in our accounts, especially in the market like this with high volatility. There's a lot of priced in time decay and a lot of IV drops that could really ruin options even if you're still right about the direction, and that's super frustrating to traders. So I want to teach you all my best option trading strategies right now. So if options interest you, make sure you click the link in the bio for our free options trading course. This will help you understand all the things I'm talking about today. So here we are on the Robinhood app, and if you don't know, Robinhood is a great app for beginners to get started out trading the stock market. It's super easy to input the trades and get in and out of it, and you can put money in and get started today. If you want a free stock, link in the bio. I love Robinhood just for beginners, but if you advance to intermediate or even expert level trading, that's where you're gonna see Robinhood screwing you over and helping you lose money over time. So I tell all my traders, once you get used to actually executing trades, you wanna head over to Webull or even Thinkorswim, which I use professionally and have been doing that for the last 5 or 6 years. But here we are on Robinhood, and as you can see, it's just a very pretty platform to look at. Right now I have $267 in my account, and I'm trading a small account challenge with this, trying to take this $250 account all the way to infinity. If you want to see more videos on that, check them in my YouTube channel. But if you want to search for a stock to trade, you just got to click at the bottom button with the magnifying glass, and I'm going to show you SPY. So we're going to use that as an example for today because I know the direction of the SPY, and I think I have an idea where it's going to be heading next week. And with that bias, I'm going to be making trades around this. So once we're on the stock we want to trade options with, what you have to do is click the trade button. And when you have applied for options and when you've got accepted, you're going to see this trade options button above buy. So that's going to allow you to trade these options for the particular stock you want to use. And once I click that, you'll see we have the whole option chain open up. Obviously, we want to get off this discover screen because we don't really want Robinhood recommending what we want to trade. We actually want to go to the dates of the options that we're looking for. So expiration dates are basically the time you have to be right about this option trade. So the direction, the spread, whatever we're teaching you today, this is the time it has to take to move. So we have March 31st being Monday, and later in the week we got April 3rd, April 6th. So a lot of these options are decaying really quickly, which is good for the strategies I'm teaching you, but very bad for someone who's buying calls and puts. Let me show you why, for example. So we have buy, and we're looking at puts right now. If I click calls, screen turns red. And sometimes that flips for some reason, the colors flip. But when I want to buy a call, we could go up and down for the strike prices, and every trader asks me the same exact question. Which strike price do I pick and how does it make me money? And here's the thing, if you're picking strike prices out of the money, they're gonna decay much faster. If I click this 262 call, and I don't think you can see the details on here, but on the desktop version, you'll be able to see the Greeks within this. So the delta, the theta, and the vega, the only Greeks I care about. Delta is how many shares it controls right now, and then vega is how much of an IV drop you could see in percentage to the price, and then theta is how much time decay. As we go up and up out of the money, which is when the prices get cheaper and cheaper and cheaper, like I'm showing you here, in the money is where this line is. So this line is at the money, below it is in the money, above it is out of the money. As I scroll up and up, it's very risky to buy these because we're out of the money, we're fighting time decay. So the longer I hold it, the more I'm losing per day, especially if it's out of the money, has a higher chance of going to zero. It actually has a very high chance of going to zero. So these options, if I'm picking these, I don't need it to run to the exact strike price. Everybody asks that question. Do I need to hit that strike price to make money? No, you just need to beat time decay and beat volatility drops and play the direction. So what that means is if I'm buying this 261 call, I just need the stock to move faster than it decays. Pretty simple. I need it to move faster than it decays. So if on Monday we gap up for the SPY, I just need that gap up to be more than I lost over the weekend through time decay. So as you know, this option probably is losing $100 over the weekend just from time decay. And if I had to guess on the Greeks, I would say this option is gonna make, let's say, $40 or $30 per dollar move. So the SPY, to make up for that $100 loss, needs to move $3 gapping up, which is possible. But again, when you're right about the direction, you want to make money. And if you're right about the 3-point gap up and you didn't make any money, it's very frustrating for option traders. But the most frustrating thing is if it does gap up and you're correct, I'm going to teach you some strategies where you can make money from that time decay and make money from the gapping up. It's gonna be really exciting, but right now we're just showing you calls and then puts over here. This is the second strategy I'm showing you. You know, you could buy puts out of the money, in the money, and again, you just have to beat the decay of the option in terms of how much movement you get in the direction where you're trying to go. So puts again are going down, so we're trying to short the market in that scenario or have the market drop. What you could do, this is super risky, is you could sell puts and calls. Like I said, over the weekend, we might get $100 decay just from this option going from Friday till Monday. You can make $100 if it doesn't move. So if that happens, then when you're selling options, you make money. So if I click this 249 put, if the option gaps up on Monday, so for puts, if we're selling puts, we want the option to be above this price on expiration date because it's going straight to zero. So if I click one contract and we have 887, this option is gonna go from $887 all the way to zero. So as you're seeing right now, this option, if I'm selling it, is going into my account as a credit. As it's saying right here, it's a minimum credit. Credit means into your account. So you're getting about $900 for shorting this option. And what you need to see this actually make you profit, like I said before, is you need the price of the stock to be above 249 on the expiration date, which is 4/6. You can make $900 within a week if this stock is above 249. So that's shorting puts. That's what it's called when you're not protected. Because what can happen is when you're short an option like this 248 put, somebody on the other side of this option has the right to buy 100 shares or sell 100 shares of the stock, depending on if it's put or calls. So for example, if I'm holding this put for 248, someone on the other side may exercise their option and it may be connected to me and I may have to sell them 100 shares of the SPY. You do the math, 100 times 25 or 252, it doesn't look good, trust me. It's 25K. So if you don't have 25K in your account, that's where it gets scary. That's where I see people, owe more money than they have in their own account. So open shorting, super risky for traders to do, and I highly don't suggest it unless you really, really know what you're doing. You never want to go naked calls. It's the riskiest thing you can do in the market with options. But what I want to teach you now is spreads. So that was scenario 1, 2 for buying puts and calls. Selling puts and calls is 3 and 4. And now I'm going to teach you something called a call credit spread. Super exciting because credit again means money going in your account. So let's go up to the calls and we're going to sell one. We're going to sell one right away and then we're going to buy one. And on the app, you have to do this unique thing to actually make this happen. So again, the SPY, I'm very bearish on it next week. I don't think we're going to cross 260. That's going to be resistance in my mind. If we don't cross 260, I could be selling calls above 260 because I know those calls have a very, very high chance of expiring worthless. So again, we're looking at that 260 call and that is $700. So that's $700 in my account. And what I did, because I'm making a multi-option order, is I have to click select at the top. This 260 call, I'm gonna be selling. Again, $700 in my account, but I have to be protected. So I have to buy a call because that gives me the right to buy shares, 100 shares of this stock. Because if I sell something, someone else has the right to buy 100 shares from me, and I want to make sure I have the right to buy 100 shares if I get exercised by someone else. Super confusing, but you don't want to be caught up in this, so make sure you understand that. So again, if I'm bearish on the market, I'm hitting resistance, I'm going to be selling calls. And if I want to sell a spread, I go to buy, and I'm going to be buying a call, and I just have to pick anything over this strike price I already had. So this is where you make more profit or you require more safety in the trade. The higher up you go, the more you risk, but the more you make. And at some point, it makes a lot of sense to do this trade. So for example, if I click the 261 call, if I'm buying that, I have the difference between 1 on the strike price. So that is part of what I risk minus the credit. So in this trade, I'm risking $100, which is 261 minus 260, and I subtract that from 46, which is the credit going into my account. So in this trade, I'm risking about $50. I'm trying to make about $50. That's a 1-to-1 risk to reward ratio. That's pretty good. So right here, as you can see, this is a call credit spread. If you did not input this correctly, it's going to say something different on the confirmation screen. For the call credit spread, credit into your account, you're going to make $46 just by pressing enter. But you don't get to keep that $46 unless we close the stock below 260. And you get a little bit sketchy if you close above 260, because that's where you can get exercised. That's where you're in the money, but people do exercise out of the money as well. That's something that we may have to do if we get exercised. But I'm going to delete that buy order for that 261. I'm going to scroll up, and we're going to scroll up high. We're going to go to the 280s, and I'm going to show you what happens here. So if I click 280, this is what happens to the credit going into my account. It's now $600. Boom, $600 into my account using this call credit spread, because I'm bearish. I think we're going in a recession. I think we see selling off. So the amount I'm risking is a lot though. So this is going to blow your mind. We have 280 minus 260, which is 20 times 100, which is about $2,000. So we're risking 2,000. We're trying to make 600. Everyone's going to say it's a terrible risk to reward ratio, about 1-to-3, 1-to-4 reward to risk. So you're risking more, way more. But here's the thing. This is a high probability setup because I know we're going to decay. Even if we do pop, I still make money. Even if we trade sideways, I make money. Even if we drop, I make money. So this is a 3 scenario play where if we go up, down, sideways, this option is going to make me money every single day just from that time decay. Because like I said, I have that 260 call I'm selling. So every day that's making me money. And that 280 call, I'm losing money on that, but it's less expensive. So I'm not losing as much. So throughout both of those options, I'm going to be making a good amount per day just from time decay. And if volatility drops, I make even more. So that's a call credit spread. And that's if I'm bearish about the market. Now I'll show you if I'm bullish, what do I do with this scenario? So I'm going to delete those 2 options. And what we're going to do is end up doing a call debit spread. And this is if I'm bullish. So like I said, if I think we're going to pop $3 in the morning in the SPY, I want to make money from that. And if I know time decay is going to eat me alive in the morning, I want to be able to save myself from that. So this scenario is going to be able to help you do that. So we're going to start out with buying a call in the first place. So the first thing we want to do is buy a call, and it can be in the money, at the money, wherever you want. Basically, it doesn't matter where we buy this call because we just want to protect ourselves with the next call we're selling. So I'm going to be buying this in the money, this 252 call, because I want to control as much delta as possible. You control more delta as you get more and more in the money. And here's what I want to do. I want to sell a call where I don't think we're going to go, where I think there's resistance. Like I said before, 260, a perfect place of resistance. So at 260, I don't think the stock is going to get there, and I'm selling that call, meaning I'm going to collect that $700 still in this trade. So in this trade, $700 going into my account from selling that call, and I get protected from time decay. So every single day, that $700 is decaying totally and hopefully going into my account. Again, this call I'm buying, I'm gonna go to this screen for you. The 252 call I bought for 1,100 bucks, that one I'm losing money on per day. But as long as I get movement upwards, this looks like a safe trade. So it took me multiple years to figure out how to read setups, and I'm gonna give you my best ones with the link in the bio. This is a $3 ebook. Check it out on Amazon. So the point about the call debit spread is if you're bullish about the market, you can profit from upwards movement, and you could be selling calls that are above certain resistance that you don't think we're gonna get to. Basically levels you don't think we're gonna touch, because that option we can just collect totally in our account. So here we are with the 252 call, and then we're protected with the 260 sell. So here's what's gonna happen. The most you're risking in this, or the most you can make in this trade, is the difference between the strike prices, which is 260 minus 252, which is 800 bucks, and you subtract out the cost. So the cost of the trade is 400. So we're looking to make 800, and we're trying to get in at 400. So that is possible 100% return. And the most we're risking is our initial investment, which is 430 bucks. Pretty easy. You risk what you put in. So we're trying to make 800, we're risking 400. That's a 1 to 2 risk to reward ratio. So it gets better as risk to reward when you're doing debit spreads. But again, you need movement. So you really need movement to happen in one direction, up. You don't make money from sideways movement. You don't make money from drops. That's why I like the call credit spread and even the put credit spread I'm gonna teach you about next, because you make money in 3 directions. Small movements up, small movements sideways, movements down. So the debit spreads, I'm not a big fan of, honestly, but there is this one strategy that I just learned about over the weekend, which I'm pretty interested in. So this is called the Ghetto Spread. Pretty cool concept, but this is where you already own a put or call and you're making money. So you're making tons of money on this trade. For example, in my premium option trading group, we had these TLT calls soar from 50 bucks all the way up to about 98, basically 100% return just in our live stream on Friday. So that was with my live, and that was with my trading group. So as you can see, my return is only 16%. I got in a little bit late. I got in at $77, but I have 16% in this trade. So that's really good. And if I go to 50%, I want to think about, how do I lock this in? How do I make the most in this setup? And this is a ghetto spread. So this is something I just found a concept on this over the internet on YouTube. If you go to view TLT, then we go to trade options. If you're up on a call, you can sell calls at a higher strike price and basically profit from the premium being lost up top, and you can profit from the option you have that's already still going up. Or worst case scenario, the stock doesn't go up anymore and it drops. Now you're fully protected because you sold that option above. So that's free credit. You're gonna collect all of that in your account. So here we are. As we see, we have the buy, and if I scroll up, you're gonna see I have a +1 where I have the 172.5 call. So that call is the one I own. That's the one making me money. What I wanna do is I wanna sell a call above me because I wanna be able to collect that full premium if the stock dropped, or even if it ran up to the price and didn't break that price. So again, when you're selling options, you just want it to stay below if it's a call or stay above if it's a put. So I would be selling maybe this 180 call. And if I click here, we see we have 30 bucks going into our account. So in this trade, I'm up 16 bucks. For selling this call, I'm gonna make 30 bucks. So that overall is boosting me to a 50% return. So what I need to make money from this setup is we just need to either pop to 180, not go above it, because at 180, I've capped my profits. My profits are the difference between the strike prices, 172.5 and 180, which is about 750 bucks. It's not bad for this setup. So 750 bucks for a $70 option. That's over 1,000% return right there. So that's the Ghetto Spread, but here's the best part about the Ghetto Spread. It's just a weird name, is that the 30 bucks I got from selling that option, you know, I have to lose 50% of this option I own on the calls to break even. So for me, just to break even, the option I bought originally has to drop 50% now. So that gives me a lot of leeway to be wrong about this setup. So I like that because, again, you protect your profits, you make money from selling, and if you're wrong about the direction and you hit a top early, you're still going to make money in this trade, and there's going to be a nice buffer to the point where you're not making money in this trade. So the break-even point gets even lower in this trade because you sold that option. So let's go back to the SPY. We're going to teach you just a couple more for the puts. So we're going to do a put credit spread and a put debit spread. So we're going to go again to the April 6th options, and we're going to go to puts. And again, you can do this for bearish and bullish depending on if you're doing credit or debit spreads. So what we want to do is we want to sell a put first. So this is going to be a bullish scenario. Whenever you're selling first, that is bullish for puts, bearish for calls. So we want to sell the 248 put. For some reason, who knows, maybe we have support there. Maybe we bounce when we hit that level and we never drop lower. That's the ideal scenario for selling this put credit spread. So 248 put, sell that thing. Now what we're going to do is we're going to buy a put lower than that. That has to be our protection. If we don't have that, it's not going to help us out. So again, you can go as close as possible to those strike prices, but you're not going to make as much. So for this setup, you're risking about 248 minus 247, the difference of the strike prices. You're risking $100 minus the credit, which is 35. So you're risking $70 to make 35. So 1 to 2 or 2 to 1 risk reward ratio. If we move this even further down, let's move it down to like 230. And again, the further down you move it, the more you're risking yourself. So for this setup now, we're risking 248 minus 230, which is 18, which is $1,800. Difference of the strike prices minus the credit. So $1,400, so $1,300. And you're trying to make about $500. So that would be about 3 to 1 risk to reward ratio. So again, not great, but when you're selling puts and you're selling calls and you have this credit spread, very high scenario that it works out, because again, you make money if it trades sideways, completely sideways. You make 100% of what you're getting it as a credit. If it trades sideways till expiration, you're making money if it pops. So, if you're bullish on the market, this pop, you're going to get that 100% credit in your account if it keeps popping till expiration. You're even going to make money if it drops. The best part is you're going to make money if it goes against you towards 248. You'll make the full money in your account as long as it stays above 248 by the expiration date. So 3 ways you make money on a put credit spread. It's super exciting. I love this one. So now let's just delete these ones. And what we're going to do is do a put debit spread. This is if you're bearish about the market. So what we want to do is we want to buy a put first. So what I'm going to do, I might buy that 252 put. And again, the reason we're selling a put is because we want to profit from that time decay that's probably going to happen just from us holding it over the weekend. So I have to scroll down, and the further I scroll, the more possible money I can make, but the less I'm going to make from time decay and the less I'm going to make from selling an option. So this 243 is going to put me at a total cost of $300. This is very interesting. If I didn't sell that 243, we have to pay $1,000 to get in this trade. So it also lowers the amount to get into the trade. So if you have a small account, it could be very profitable for you and very easy for you to get into these spreads, even with high options like Amazon. You could be trading Amazon spreads with a $500 account. So here we are, the 252 and the 243, we have a $300 cost. And here's the thing, we can make lots of money on this just if we drop and don't go below 243. So there's a couple scenarios where you make max profit, but the most you can make is capped between the strike prices. So 252 minus 243 is $900. That's the most you can make. So you paid $300, you're trying to make 9. That's about a 3x return, 2x return. And the most we're risking is going to be our initial investment. So, we're looking at a pretty great risk to reward ratio for this single setup here, but we really want to make sure we don't drop below 243, because then we could possibly get exercised and nobody wants to go through that process. But again, if you're totally right and it drops to 220, that's fine. You capped off your profits at 900 bucks. You're done. You sell this option and you're good to go. But the best thing is if you get to 243 decays, that's a good option too. So the next thing I want to teach you about is the very last one, which is a strangle. So a strangle is where you are bullish or bearish. A strangle is where you have no clue where the option's going to move or the stock's going to move, but you know it's going to be a huge move. So a strangle is where you're going to buy a call and a put. So call and a put, a strangle is the same strike price, a straddle is different strike prices. So here we are, call and put, we're going to click buy, and I probably will buy the 253, and I have to click select due to a multi-leg order, 253 for the buy, and we go to put. Let's buy a 253, and if you pop this up for the confirmation screen, it's going to say straddle. So that's your confirmation that you inputted it correctly. So here we are with the 253 call, 253 put. This is a very expensive trade. I really hate doing this if you are playing in a volatile market, because not only you're getting time decay with one option, now you're getting time decay with two options. So twice the losses per day. So you have to be right about the movement 100%. You have to be very sure things are going to get nuts. So for this option, it's going to cost me $2,000, but here's where I start to make money. We have to have, and you add this $20 to the strike prices, we have to have a 20-point move up or a 20-point move down, meaning we have to go above 273 to make money, or we have to go below 233 to make money. So in 1 week, we need to move 20 points in the SPY. Mind you, that is almost a 10% move, which is nuts. We're trying to make a 10% move in the index, which historically has moved 7% through the whole year. So for this straddle, 273, which is adding the call price to what it cost us to get in, and then subtract that for the price we need to go below to make money. I don't like straddles for this reason. In volatile markets, the best things you should be doing is trading spreads. Spreads lower your risk, and when you're selling things, it just helps you profit from that time decay, because in volatile markets, there's gonna be tons of loss from time decay. And I see this all the time with traders, and they're losing money all the time, even holding per day, like even an hour or 2 hours, they're gonna lose money from that decay. And if you protect yourself, it just helps you become more profitable. Lastly, I'm gonna link a video on everything you need to know about Robinhood options. Check it out to the video right of me. Peace. So get this, one of my members took their account in my premium option trading group from 12K all the way to 25K in one single week. He doesn't have to worry about the pattern day trading restriction, and he did this